Bob Coleman is the CEO of Idaho Armored Vaults, and when it comes to gold and silver, he's probably forgotten more about the precious metals trade than I could ever hope to learn. And on February 16th of this year, he posted on Twitter that we could be on the verge of the mother of all short covering rallies for silver, posting a screenshot to the Commitment of Traders report that showed managed money was more than $1 billion net short silver, and how that setup was perfect for a rally in silver prices. And it turns out that call was right on the money, as the price of silver would rally from $23.38 on that day to $32.50 just a few weeks later, a rise of almost 40% in the days following that tweet. Now, that rally has since run out of steam and the price of silver has fallen back below $30 an ounce. But considering just how great a call that was on February 16th, I decided to bring Bob back on the channel to see, is this rally over? Has it run its course? Or maybe there's a second win just around the corner. What's up, guys? I'm Nobody Special, and I am here with Bob Coleman, the CEO of Idaho Armored Vaults. And we are going to talk about what is going on in the precious metals world, because it has been a crazy couple of months ever since, Bob, you nailed that call on February 16th about how we were on the verge of a big short covering rally in silver. And of course, ever since then, we've seen precious metals rally pretty intensely. And now they're taking a little bit of a breather. They've come down a little bit, especially today. We've got gold, as of the recording of this, is around 23.26. And we've got silver is down under $30 at 29.69 here. So it's a good place to stop and just review what's going on in the metals market, separate some of the facts from the FUD, and see where we might go from here. Now, Bob, the first thing I want to talk with you about is this east-west thing that we have going on, the big China arbitrage, which is particularly potent in silver, right? We're looking at almost a $5 differential now between a price of an ounce of silver in the Shanghai Gold Exchange versus what it's going for on the COMEX. So nobody's got a crystal ball, right? Nobody's on both sides of the Pacific at the same time. So nobody knows exactly what's going on here. But give me your best take. I hear mixed things. I hear some people say it's just paper. It's not really metal moving. Some people say, oh, it's this VAT tax is what's going on there, and there's really no arbitrage. What do you see that's happening over with this east-west flow of metal?
Yeah, I think there's it's one of those things that I probably know just enough to get me in trouble, I guess. But in terms of Eric Young did some great work on this over the weekend. I think last weekend put some really good pieces out there, trying to understand this himself and taking the time to kind of put that out on Twitter or X. I think for a lot of people to kind of read. But originally, I think back in last summer, you had this sort of import quota that the Chinese were establishing for precious metals, and that began this lift in precious metals in the premium versus the London market. So you started to see this, higher, I guess, accelerating premium, and part of that was possibly to try to steer the public in terms of, because at the time you had real estate debacle really starting to unfold in the stock market. They're maybe trying to arrest the decline at that point. So maybe they were trying to guide policy and limit the amount of metal that's there, so people weren't there was more competition, I guess. And then you had, there is this what they call value added tax. I think it's like 13.8%, something like that. That is naturally, when you're bringing metal into the country, that's what you're looking at. So there's this when you look at the rate, when you're looking at the price in country, it's going to be a little bit higher, but it takes into account that value added tax. So then people are saying, okay, that makes sense. It's going to be a higher premium because there's a tax involved. But then, but what Eric did was he looked at this from a standpoint of delivering metal onto the Shanghai Gold Exchange, which is in the free trade zone. So when you're bringing metal into the free trade zone, there's no value added tax. There's an exemption there. And then when you deliver it to the exchange, there's an exemption as well. So in reality, there's these licensed participants that are sort of, I guess, when the metal leaves that exchange and maybe goes into the mainland, there's this pricing, I guess, this higher pricing that those participants are allowed to to get, and I guess that profit, I guess it's like a markup almost, where they are allowed to kind of take that profit, and part of that profit actually has to do with how they're actually holding the currency after they sell the metal. They have to hold it in the renminbi. They can't just simply. It's not like you can just you know take your gold here in the United States, send it over to China, get your dollars for it, and pocket 10% and bring it back. You're actually holding it in the Chinese currency. So you're going to have exchange rate risk. You're going to have slippage, all those types of things. So maybe there's a little bit more to that premium than it's just simply, is it just London versus China? There's, the cross currency rates and that type of thing.
Okay, so I heard a couple of key points there. There was an import quota. So it sounds like China maybe tried to limit how much metal was coming in. And well, that creates a little bit of an artificial scarcity. So people started paying a little bit of a premium. It sounds like we can put that VAT tax debate to bed, that that's not what's responsible for the premium, because it at least doesn't apply to most of the metal that we see moving over there. And you also touched on the authorized participants, the licensed participants there. We'll get to that one in a second. And then the last thing you mentioned was the currency risk, and that's a big one because a lot of people are expecting the People's Bank of China will be devaluing the yuan and the renminbi very soon here to try to bail out the country from this property collapse that they see going on. So maybe they're demanding a little bit more of a premium to account for that risk in the exchange rate. So all of those things combined have resulted in this big difference that we're seeing between prices in East and West here. Now,
I
go ahead.
think I think you summarized it great there.
Okay, thank you. Well, I was just summarizing your summary, so you took the credit right back, Bob. That was all you. All right. Now, you mentioned licensed participants there a few times, and I'm pretty sure we're kind of drifting towards the ETFs there, which is a topic I wanted to cover also. I've been hearing a lot about gold and silver ETF outflows. Now, I was doing some research before this interview, trying to get my head around what is the real situation with the outflows. And it's very hard to figure out because some are reported in tons, some are reported in ounces, some are reported in dollar values. And of course, the dollar value per ton is changing in time. So it's hard to really get your head around what's going on with the ETFs, the exchange traded funds, and that metal there. So could you explain, maybe first for some of the newer folks here, what is going on with the ETFs, with the authorized participants, who they are, and what it is that they're doing? And then is it actually physical metal that's heading over to China, or is this just a paper shuffling game that's going on with the ETFs again?
Well, in terms of metal going to China, the import-export numbers definitely show metal has been moving over there. I don't think there's anyone that's going to argue that point. I think the ETFs, though, if you start to understand what the ETFs are really all about, a lot of it has to do with the vendors and the participants within the ETF. You have the sponsor, you have the transfer agent, trustee. I'm sorry. You have the custodian who holds the assets, and then you have the authorized participants that really are they create the redemption or the creation and redemption mechanism to provide the liquidity for that ETF to kind of either grow in value and size or decline in size, so that they make that market for that ETF price itself. So the authorized participants a lot of times may use the ETF as an inventory mechanism for their inventory, meaning they'll deliver the metal to the ETF, and there's ways that they can actually take advantage of that through arbitrage, meaning if the net asset value is trading at a premium, for example, they may take undervalued metal, deliver it to the exchange, get those overvalued shares, sell those overvalued shares into the market, and capture some form of arbitrage. That's very common, and that's, I think, what has been the key on at least on commodity funds is what we've seen the last 15 years. This ballooning of SLV and GLD, and then you've had this steady decline since really 2020 or so, or 2022, 2021. You've had the steady decline as the prices actually started to go back up. I think what may be happening is the authorized participants were getting more money somewhere else or more arbitrage play somewhere else. So it may not have been worthwhile to keep that metal in inventory in the ETF. They may have been pulling it out, even though you've had maybe, I find it very hard that silver breaks out of a massive channel. Inverted head and shoulders breaks out through 26, 28, hits 30, and nobody cares. I mean, that to me kind of would blow my mind. So I would imagine you probably had investor participation coming into the ETF, but you may have had a lot of inventory that was actually held by authorized participants, or other players, pull that metal out. So from a netting standpoint, it may have looked like nobody cared about the ETF, but you just had metal that was shifting around, or maybe, and you kind of see it with London as well. London, even though you had this big run up, the April numbers that came out, in early May showed just a small increase of silver, even though the silver price had shot up. So it made it look like, from a netting standpoint, a lot of metal probably was leaving as more interest was coming in, because you have to remember the ETFs are not just the U.S. You have ETCs, which are exchange traded commodity funds over in Europe, that had been seeing some pretty good inflows into the silver funds, in March, and then just recently, in May. And so it's not that everybody was just a net seller of ETFs. And I think that's where you have to peel these onion layers back, I guess, a little bit.
All right, so the authorized participants then, if the average ETF investor, right, a retail trader who goes into Robinhood or Schwab and buys a few shares of SLV, that's the kids table of the ETFs. The authorized participants there at the grown-ups tables, and they're the ones who can actually redeem the shares for the metal, right? They can actually take metal out of the vaults, and then I guess the shares just are destroyed when that happens.
Yeah, they're just redeeming the shares, taking the metal back out. But you're right. You're correct. It's just the shares are basically just redeemed and kind of put into a coffin, I guess.
Now, the act of redeeming a share should be, in theory, price neutral, right? That doesn't affect the up or down trading of the ETF or the underlying metal necessarily until some other action is taken. Is that also correct?
Um, Possibly. It depends how the authorized participant or swap dealer or whoever is interacting with the ETF. Because you got different legs of trades going on, and so some players may actually use the ETF as one leg, and they may be short futures contracts, for example. So if they're redeeming on one leg, they may be then having to cover the short on the other leg. There's a lot of this is where it gets really confusing, I think, for a lot of physical owners trying to understand how this entire financial system works in the precious metals world. The leverage, the spreads, the futures, the notional values, and margin, and that type of thing. The industry really works on spreads more so than secular positions. They're not just gambling. Hey, I'm going to short $500 billion worth of silver, and let's hope it goes down $2. I mean, that's insanity. It may appear that way to some people, but they may not understand that there's multiple markets. There's the futures markets. There's OTC markets. There's other exchanges around the world that are all coming into play, private transactions, that type of thing, and that all gets netted sort of at the end of the day. The concern would obviously be one of the players gets in trouble, and all of a sudden the counterparty risk starts to fail, and then you have the domino effect, like you had in the financial crisis of 2008, or I think GameStop scenario, in 2021 kind of exemplified the risk of, hey, these clearing firms could really go underwater really quick, whether the prices go up or if the prices even skyrocket. If they're short, they could really get hammered. And I think that's where it gets frustrating for a lot of physical owners, because they see these markets as leveraged, and they're like, at some point, someone's going to get called. But in reality, there's just a lot of matching or netting of positions that are going on.
And the last on the ETF topic, Do you have any idea as far as the scale of these outflows? I mean, are we talking major chunks of these ETFs have been redeemed in the last year or so, or are we talking a very gradual drawdown? I mean, the ETFs are not going to be drained dry next week, are they?
No, no. I mean, you can look at SLV, and you could, the nice thing with SLV is they're very transparent. You can go and download the historical. It's right on they even put on a spreadsheet so you could graph the thing, but you can kind of see that there's been this sort of rise and fall, but really since February, it's gone nowhere actually. I mean, it's may have come down actually a little bit. I didn't see the numbers last night, but it's kind of unreal to think that, oh my God, the price has gone from 22 to 30 and nobody cares. This has to be one of the oddest times where investors who are trying to analyze the markets and trying to say, okay, I thought ETFs were a big portion of the pricing mechanism or price discovery, and I'm realizing that the ETFs really don't have anything to do with pricing discovery. It's actually maybe reverting back to the physical asset itself, which is what I was saying back in 2022 when Basel III was being implemented back in June of 2022, and saying, listen, the market is deleveraging is what's happening, and the banks are getting out of this business of creating all this unnecessary exposure through unallocated accounts and so forth, and using their balance sheet to be the counterparty to someone who wants to own gold or silver. There was this Basel III kind of interrupted that and actually penalized those unallocated type positions where they had to increase the reserve ratios and that type of thing. So I think what's happening is, I think the authorized participants, as this deleveraging game continues, I think, and then you've had just a massive amount of buying from India and China over the last say year or the last 6 months. I think that's having that outsized effect of, okay, if you're a hedge fund or if you're a CTA and you're shorting the futures contract, expecting the Fed to raise rates or maybe not lower rates at all, and they went full. That's when I kind of saw that $1 billion notional short position amongst managed money back in February, and I said, oh my God, this is like I think it only did that like 5% of the time for the last 20 years that the COT had been reporting this. The boat was too like heavy on one side, on the short side of the market, and so that basically got, that you saw this massive transition start to take hold and the market start to strengthen, and at the same time you had this massive increase in silver usage, industrial usage, and solar panels and so forth. So all that kind of came together to create this sort of squeeze in price.
So let's talk about that February 16th tweet, because that was really pretty. That was just dang impressive, Bob. Here it is up on the screen here. We're looking at a commitment to traders report. He says, we could be on the verge of the mother of all short covering rallies for silver. Managed money is now $1 billion net short in notional value. Can you dig it? I think that's a reference to the Warriors there. It's a great movie, by the way.
I love that movie.
That is a great flick, yeah. So I see you've highlighted a couple of fields here on this commitment to traders report. Could you talk a little bit about why you zeroed in on those particular data points and what they were saying, and phrases for somebody who maybe doesn't read these reports on a regular basis, so they would know what they're looking at here?
Yeah, I mean, basically what you're trying to look at is periods of time, similar to where these positions have been. Sorry about this. Similar periods of time that you can look at where you had this similar type of positioning, and then what happened after that. And so when managed money gets really, really short or really, really long like they are now, you tend to get to what they call an extreme. You'll get a reversion of that mean, so to speak. So the last couple of weeks, managed money was exceptionally long the market. Swap dealers were exceptionally short, and so we're getting this pullback. The pullback doesn't mean that the top is in. It just means you're having some positioning changes, or you're moving off of these extreme positions that have been formed, and it's allowing the market to breathe. This is all a part of consolidation after a big move. You're going to get the tree shaken a little bit. Remember, you're dealing on leverage. They raised margin requirements on silver a few weeks ago. I mean, all these things start to kind of weigh on players who are margining and leveraging their positions. And typically, when the market starts pulling back, those are the players they call the weak hands that literally don't sit through that type of volatility. They take their profits and they wait for the next positioning move or the next opportunity or setup, and then they play back. They start the clock again. That's all that's happening here. It's not that we're, oh my God, it's the end of the market. The gold market's going to crash and silver's going to go back down to 22. I think those days are sort of gone. Now you're building this sort of. This is very constructive because now you're starting to see how people react on the pullback. If you're starting to see people buy the dip, that will start to alleviate some of this inventory that maybe dealers and wholesalers have taken in, because you're still getting two-sided trades coming in. You're still getting people selling into the market saying, hey, listen, I've finally broken out even on this, after 15 years of holding this. And you still, and then there's people that, that luckily, they may have bought, in the low 20s or the teens, and they're like, hey, that silver was a great store of value. Now I want to spend it on real estate or start a business or whatever it may be. So that those are, because people don't, they got to remember that the metals are as a store of value, they're also a source of funds, and so it's just natural you're going to get this, people selling back into the market, and so these pullbacks I think are good to look at to see how that inventory starts to shift within the industry. And if they start to see maybe more buying on that dip, people are maybe starting to wake up in the Western world saying, I missed that rally from 26 to 32. Well, now it's pulled back to 29 and change, and it's maybe back at the low end of the range, because what you're trying to see is if the market's trying to define a new trading range at the same time. So this move that went through 26 got it up to 20, the 28 to 32 range would be the natural next range to be looking at as it's consolidating and waiting for that next, I guess, secular move, either higher or lower.
And just for some of the nomenclature here, when we see managed money as that category in the middle, we're talking whether those are like your hedge funds, right? Your
CTAs,
big players.
mainly CTAs, a commodity trading advisors. So those guys they'll look at silver not as, hey, listen, this is money and this is I'm going to hold this thing forever, and the dollar's going to go get crushed. They're looking at silver as just an instrument to represent maybe whether it's undervalued or overvalued, and they they compare it against interest rates, or they compare it against other metals or other commodities, and or they may take a sort of a macro approach to investing. So they're looking at the economy as a whole. Is the economy slowing down? Silver is an industrial metal. It's going to see less demand. And, so there's multiple things that these CTAs are looking at, not just simply the dollar, what the dollar is doing, or interest rates, or geopolitical tensions and things like that. So, the problem is when geopolitical tensions come into the picture, it starts to throw their model sort of out of whack, because it's something that they weren't accounting for, or it wasn't built into that formula at that moment. So they may have to adjust, and that's when they start changing the positioning and that type of thing.
Well, Bob, this was an excellent call. When you posted this tweet, the price of silver was at $23.38. That was the closing price on February 16th. And then it went as high as about 32.50. So almost a 40% rally within a few weeks of this tweet being posted. So fantastic call here. And it was that big net short position of the managed money. That was what cued you in that something was up here, that, hey, there could be this big rally there. And now that has worked its way through. And so the managed money's more of is it a neutral positioning now? Or are they net long now? Or
they're big time net long. So now at this point, this this pullback, again, you're watching the commitment of traders reports. You're gonna see that sort of net long positions start to diminish. I'm sure that the sell-off today is let's see. Yeah, so
Over a
this is
dollar today.
Tuesday. Yeah,
Yeah.
so this is Tuesday. So this sell-off today will be reflective in Friday's report, because when Friday's report comes out, it's really from Tuesday to Tuesday, and then you have this sort of time gap to when it's actually reported. So you should see that the managed money crowd, that positioning decline. You'll probably see commercial short positions decline as well, because they probably were covering into the sell-off. But you got to remember that when managed money is selling, somebody else has to buy that, and that's where this two-sided accounting or trading that comes into place. It's not that everyone's just naked short. There's this sort of idea that there's always someone buying and selling at the same time.
Now, historically, every time metal prices rise, you start to see the rhetoric starts to pick up a little bit, and we saw that over the last few weeks. I know you've called it out a lot on X and Twitter. We're starting to see a resurgence of some of those more spectacular talking points, we'll say. We're starting to hear a lot about, the BRICS gold-backed currency. That talk is coming back, and there's talk of metal shortages out there. Give me your take on some of these more wild talking points out there. I'm assuming you're going to temper some of that enthusiasm here, and that's fine. That's why I brought you in here. And what are some of the signs people should look for to make sure they're not just being sold hype by somebody whose interests maybe aren't necessarily aligned with theirs?
Yeah, and this is the hard part about an industry that's unregulated. So people can say really whatever they want. They can, you can throw emotion into it and create some sort of, where it's really an advertisement, but they call it analysis. So you have, it's harder for the investor to kind of decipher, okay, what's real, what's not, because someone may have made a good call, and then all of a sudden the guy is now saying you got 500 million ounces short or something like that, or $500 billion worth of silver short, and all of a sudden everything's going to hit the fan, and the institutions are going to go bankrupt, and the banks are going to go to zero, and the dollar is going to collapse, and the real estate's going to go to zero. And I mean, you got to put some degree of brakes on some of this stuff. And so what's happening, I think, with the silver market is there's no question you have an increasing industrial demand. And that's the numbers speak for itself. There's no question that we've hit peak production in silver. It peaked out in 2016. So that's a fact. I think this silver shortage idea, though, I think it's being sort of captivated to sell product and to sell services. But I think what people miss is there's a lot of above ground silver, just investors like you and I that, may have bought at 15 or may have bought at 20 or 25. And if silver goes to 40 or goes to 50, the investors are going to sell that silver into the market. It's just a natural event that's going to happen. People are going to take profits, but that above ground silver then becomes the supply that maybe mining supply isn't providing. So if there's a supply deficit, you're going to see that extra metal come from investors. It's going to come from exchanges, and that's what we've been seeing. We've been seeing this drawdown from the COMEX. We've been seeing this drawdown from the LBMA over the last few years, and that's where the supply deficits have been met from. So that will continue. But I think what's important to note, though, is that to drive to get someone like you or I to sell our silver, we may want a higher price to do it. We may not be selling it at $30, but we may be interested if it's at 60 or if it's at 50 or whatever that number is. And that's when you may see more metal coming into the market, and that's what will drive the price higher, especially if you don't see a lot of mining activity being born from this higher price.
So you're kind of feeding into the next topic I wanted to talk about there, which is premiums. And I think does what's happening with premiums support some of what you just said, because the prior rallies that I've seen in silver, I haven't been doing this all that long, but when I've seen the price of silver rally a couple of bucks, it's typically been accompanied by a blowout in premiums. I mean, we saw premiums almost $20 for American Silver Eagles about 2 years ago. We're nowhere near that right now.
No.
So what's going on with the premiums, and what information can you glean from that?
Yeah, the if you look at the two-way selling that started about mid part last year and started to pick up into last year, into the end of the year, and then into February when it crescendoed, meaning you had just a lot of selling back and not a lot of buying. I guess you could say there was maybe 60 or 70% selling back into the market, and 30%, people were actually buying from dealers. Well, what's happened is um, uh, that that massive amount of inventory and carrying costs that those dealers were taking in started to lower those bids. Initially, it's the bids that drop, and then when they can't sell the product, then they have to start lowering their offer prices to try and incentivize people to come in and buy. And, and so, with the price starting to move, you're absolutely right. The last, from 2020 to 2023, when March of 23, every time you had an event, the industry would basically profiteer from that, meaning you get a surge of people coming into the market wanting to buy because whether it's a banking crisis or the invasion of Ukraine or something else happening, governments announcing they're printing even more money. You just had this wave of retailers coming into the market. The industry saw that, created a little bit of tightness on the product side. So hey, well, if they're going to create the tightness, I'm going to charge you more for the product, and I'm not just going to charge you, maybe 2 or 3% more. I'm going to charge you 20% more. I mean, it was really some serious price gouging that I was seeing, and that's what kind of got me off the sort of the fence and saying, listen, the industry can't be doing this, and retail dealers and the industry itself has to be more proactive and responsible to cater to the consumer and not gouge them, because the consumer is going to walk away at some point. And that's exactly what's really started to happen last year. As rates got to 5% on T-bills, you just simply had more competition for money, and so people were selling the metals. They had owned it for 15 years. They need income now. They're in their retired years, and so it makes sense to start turning their assets into other types of vehicles. And that's what kind of started this sort of this ball rolling, and metal coming back into the system and premiums declining. And I think you're seeing in today's market, you're seeing retail dealers with some pretty bad bids still. I mean, everyone talks about shortages, but you're seeing prominent online retailers, bidding $1, $1.50, $2 under spot for 100-ounce bars, 1-ounce rounds, products that they were selling for $4, $5, $6 over spot a couple of years ago. And so consumers are seeing that as well, and they're saying, well, God, I bought this and expecting the price to go up. The price did go up, and I'm still not even getting $30 an ounce for it when I sell it back. And that wears on people. That's it's a difficult. I know, I totally get the idea. Dealers need to make money. I totally understand it, respect it completely. But at the same time, this is an asset that we're trying to say, listen, it's an investment. It's not like a teacup from Walmart that the only way you're going to get your money back is if you return it 2 days later. People can't take this 10% or 20% or 30 or 40% spread hit on their money, and still expect to come back for more. The metals are, I think, are a great place to be, but that's why I'm very sensitive to premiums, and I don't like to mark this stuff up. And I've been a big advocate over the last 4 or 5 years, really since 2009, since I've been selling metals. To keep those premiums as low as possible, because no one knows where the bid is going to be. If silver goes to 45, you could have a situation like in 1980 when you had silver go to $50. If you had junk silver and you were selling it to a refiner, you were getting $38 an ounce for it, because they were so backed up in terms of processing that metal, melting it down, and so forth. They had to account for that lead time of 6 weeks or whatever it may have been. So trying to explain that to people, I think, is important. Have some form of disclosure or transparency, not just simply saying, hey, listen, you got to buy silver eagles at $20 over spot because you're never going to get that price again.
So the industry did kind of, maybe they didn't outright kill the golden goose, but they beat on it a little bit, didn't they, with the price gouging? And now you've got people who maybe the rising cost of living is causing them a little bit of stress, so they're unloading some of that metal that they bought. And even though the price is higher, they're getting back less than they paid for it because they're offering underspot in the premium when they paid so much over when they bought it a few years ago. So
yeah, it's upsetting to see, only from a standpoint of I'd like to see the industry be more competitive with other assets out there. I mean, I guess it's one of the things with Bitcoin. You don't see Bitcoin at a 10% or 20% discount, or at a 20% premium. I'd like to see the metals be more streamlined, and that's one of the things I've been sort of an advocate to, for some type of national exchange or some sort of national pricing mechanism that provides a lot more transparency and a lot tighter market.
now, one more topic I wanted to touch on. It might be a little bit outside of your wheelhouse, but it has been a thing lately. Copper. We heard a lot about a copper squeeze a few weeks ago. Copper futures were over $5. They hit an all-time high, and they've kind of come down since then. And I know a lot of silver comes from copper mines and higher copper prices. Maybe I've heard that the copper space has been underinvested, and now it's resulting in supply squeezes. I also heard some of that China dynamic, that there was actually metal going from China back west because you had the squeeze going on at the LME. Maybe people were caught off sides on the London Metals Exchange, and so they were trying to buy metal in the east. So what was that whole story going on with copper there? And is that something that's in the rearview mirror, or is this an ongoing thing?
Well, I'm not an expert on copper, but if you look at the forward curve on copper, let's say you just take the futures markets, the COMEX, and you go out 6 or 9 months or a year, you're not at backwardation, but you're not at a very you're almost flatlined. To be honest with you, there's not much contango, meaning the December contract is much higher than the July contract. So it's telling you that there is still tightness in the copper market, and that that could flare up again. And part of this, the smash down in commodities, especially oil here lately, you could make a very good argument. We're in an election year at this point, and the last thing that the administration wants to see is a resurgence of inflation. They're trying to get a potential rate cut going because I think the economy is softening under the surface, I guess you could say, against all those perfect numbers out there that were given.
We had a 300,000 drop in the JOLTS number today for job openings in the U.S., so I don't know how below the surface that really is anymore. Even Bloomberg is starting to admit that there's a little more than bad vibes going on in this economy right now.
Yeah,
So.
totally. Yeah. And so the idea would be, if you're in an election year, there's going to be a lot of management of the markets. And they're going to try to paint the picture of we need to get a rate cut. People are going to vote with their pocketbooks. If we can try and get the S&P 500 up, even more going into the election, that's only going to strengthen our position as the current, as the incumbent. I think that's what's happening. In all honesty, I mean, if you're just trying to keep it really simple, I think after the election, I think it's going to be a totally different story, and I think that that recession is going to be appear much clearer, I guess you could say, and I think that's going to drive gold and silver higher, because I think you're going to see this uncertainty kind of come into the picture. The question of the dollar potentially going down, toward that 100 mark, or breaking the 100 mark on the DXY. I think you're going to start to see that start to formulate going into 2025. So this story that we're seeing kind of unfold here with the metals initially surging and sort of this idea that, okay, it's a one-off type of trade. I don't buy it. I mean, you have this massive base on silver that's been built over the last 3 or 4 years, and it just broke out over it, and you got this sort of inverted head and shoulders, and the chart formation is. I mean, I did this on Twitter. I posted this not only last August, but we talked about it at the Silver Symposium, this inverted head and shoulders, comparing it to the 2008 to 2011 silver chart. And basically, this 2000, we're in that sort of period where things can really start to zoom. And I think you got to be very respectful of that. And even though maybe short term, the positioning is one sided, on the managed money side to the long side, and they may get shaken here a little bit, I don't think that's going to diminish the longer term positioning.
So it sounds a little more like maybe tempering the enthusiasm that we might find elsewhere in the market in the short term. We're not going to see all-time highs next week, but at the same time, structurally, we're probably looking at a market that is over the medium and the long run headed higher, more towards a 2008, 2011 timeframe, which was a very good time for silver investors.
Yeah, and that's what I try to. I'm not a big person on fear mongering and saying silver is going to go to $1,000 and in the next 6 weeks, and it's going to blow through 35 and go to 50. In July. You got to temper your enthusiasm a little bit as a physical investor, because it's patience in the market when you're dealing with a physical asset, unlike leverage and margin where it's all about timing. I mean, especially if you're playing the options market, you're trying to catch the move as it's starting, or catch that wave and using that momentum to kind of give you that advantage and profit mechanism. The physical market, you just got to be patient.
Now, Bob, in addition to running Idaho Armored Vaults, I understand you've got a new operation. Tell me about Tier 1 Tactical. What is going on over there?
Yeah, that Tier 1 Tactical is a sort of subsidiary we created. We get a lot of questions with the gear that we use and that we train with, and obviously use to protect ourselves. So it's sort of become an evolution for us, as we're also the only depository in the world, I believe, that's also a federal firearms license dealer. When we use the type of gear like body level 4 body armor or thermal imaging or night vision and that type of thing, we now put that on a website to kind of show people, hey, listen, this is the kind of gear that you don't buy at the sporting goods store, but it's available out there, especially for a lot of people that are saying, listen, I'm getting more concerned about the economy and the politics and so forth, and I made this money. I want to protect not only my wealth, but I want to protect myself. This is another avenue or another tool that people can start looking at to say, listen, I never even knew I could even get this stuff. Now it's available out there for the public. Of course, there's some caveats, but at least there's stuff that people can kind of review and look at and try to understand. It's not just simply whatever's available at their local sporting goods store. There's actually some really good equipment, especially with technology today. We wanted to kind of showcase that.
So besides the big stacks of shiny, we're also talking body armor and thermals and all kinds of things that go boom. You guys have just the best toys out there in Idaho, don't you? You can feel the envy here, can't you?
It's one thing about a vault. Engineers love us when you mix guns, gold, and all that stuff together. It gets exciting. So.
Yeah, I'm booking flights to Idaho as we speak here, Bob. I'm going to be banging at your door next week, whether you invited me or not. So, all right. Well, Bob, thank you so much for taking the time to talk to us today, to separate some of the facts from the FUD and share your clearly vast knowledge of the metals market with my viewers. I appreciate that very much. Once again, folks, that is Bob Coleman, the CEO of Idaho Armored Vaults and the newly minted tier1tactical.org. I'll put links to all that good stuff down below as well. You should be following him on X. He is at Profits Plus ID on Twitter. And if you had been following him on Twitter, you would have caught that February 16th tweet that ended up being a monster call. Congratulations again for that, Bob. And everybody, until next time, live small and dream big.